So let us continue with overview of model tax conventions. Taxation of income. Now my dear friends, please understand we are going to discuss a lot of incomes here. Income in the nature of business or from the source of business. Income from the in the nature of interest. Income in the nature of royalty. Income in the nature of fees for technical services. You can understand globally these are the four major income that one person can earn, and we are going to discuss the taxability of this four income in which state. See, there is always fight between resident states, country of residence or country of source. Okay, or reversely I should say, source country you should always imagine India, and country of residence, please understand, residence you should consider outside India. So foreigners, when they are earning income in India from business, then who will take the tax? Source state or resident state. When interest is earned from India by the foreigners, which country will take tax? Source states or resident state. When royalty income or fees for technical services income is earned by the non-residents from India, which country will take tax? India, source states or resident state? This is the fight which will be clarified through the various articles of these model tax conventions. Now different article, see, OECD will have different law and your United Nations will have different law, because OECD model, as I told you earlier, focuses more on the resident states, whereas United Nations model also considers source states. Okay, I did not say they focuses or they put whole emphasis on source state, but they also consider source state and they try to give more preference, more weightage to the source states. So first we are talking about Article 7 business profits, how the business profit is going to be taxed. See, we are not going to talk about computational mechanism. Computational mechanism will be given by the domestic law. We are just talking about a right to take tax on the business income. Which country is having right to take tax? Okay. Right of contracting states to tax the business profits. OECD model and United Nations model. First let's look at this para. Business profits of enterprise can only be taxed by the resident state. That's a primary rule. Business should be taxable. Business profit should be taxable in the resident state. Obviously, you can understand this is the language of OECD model. Right of source state to tax business profit of enterprise only exists. Please understand, only exists if a P exists in its jurisdiction. Only permanent establishment is there. So please understand, this is India and this is foreign country. One of the company of the foreign country is having permanent establishment in India. What they are saying, the source states can tax only such income which is attributable to the permanent establishment. So the total income, total business profit of this entity is 100 crore. Out of 100 crore, only 35 crore was earned in India through permanent establishment. So this article is saying not 100 crore, only 35 crore can be taxed in India. Please understand, that depends upon the double taxation avoidance agreement. But if it is taxable, only 35 crore will be taxable. By default, this 100 crore will become taxable in the country of residence. In the country of residence, in the source country, there will be only 35 crore taxable maximum. It may not be taxable. It may be 0 year and 100 year. It might be 35 year, 65 there. It might be 35 year and 100 there, and then there will be tax credit given by the country of residence. So these particular terminologies or methodologies will be adopted. You don't have to be worried about it. There won't be double taxation, obviously. Because of that only we are studying whole these conventions. Now, very important aspect, very important aspect. This is the law for both. This is applicable for OECD as well as United Nations. It's a common law, but one difference is there that you need to understand, and that is force of attraction rule. Force of attraction rule. So what do you mean by force of attraction rule? These foreign entities, no my dear friend, they are very smart. They always find escape route. The agreement says, the DTAA agreement says, only income derived through permanent establishment is taxable. So what this permanent establishment was doing very smartly, some of the business they were doing on their own name. Okay, that is Indian branch name, and some of the business they were doing on the name directly of the foreign enterprise. Please understand. So you can understand they are playing a very good game. 35 crore they are booking on their own name, but another 45 crore they are booking on the foreign entity's name, and they are showing the document in a such a way that all the business, every transaction was done by the foreign enterprise, and therefore this 45 crore should not become taxable in India. This was the game they were playing. Now in 2017, our government became little smarter and they amended the concept of permanent establishment by putting this force of attraction rule. According to force of attraction rule now, my dear friend, so what is these rules we were talking about? Right of contracting state to tax the business profit. Please understand, according to OECD model, that is for developed countries, once PE is proven, the source state can tax only such profit which are directly attributable to the permanent establishment. The same language is written there also in United Nations, but the definition of income attributable to permanent establishment is wider now. Okay, the attribution principle is amplified means you should understand, when we talk on the speaker, the amplifier will throw the sound, it will increase the sound, so kind of expanded. Okay, amplified by the limited force of attraction rule. So this is very important, force of attraction rule. The force of attraction rule implies that when the foreign enterprises set up the permanent establishment in source state, so you need to always understand like this, foreign enterprise is putting the permanent establishment in India, it brings itself within the fiscal jurisdiction of the state to such a degree that profit of that enterprise derives therefrom, whether through the PE or not. Whether through the PE, also whatever the income they have earned through PE, that is also taxable. Even if it is not through the PE, directly done in India, still it is taxable. Okay, can be taxed by it. That is in source states. Accordingly, if the enterprise carries on the business in other contracting states through a PE, the profit of the enterprise may be taxed in the other contracting state, but only so much of them as attributable to that PE. Sales in the other contracting state of goods or merchandise of the same or similar kind as those sold through that PE. So direct sale, direct PE, full income is taxable. Same goods are sold directly by the foreign enterprise, goods or services which are similar in nature. Obviously the benefit is given only when the goods and services are similar in nature, and other business activity carried on by the in that other state in the same or similar kind as those affected through that PE. So whatever the PE is doing, either direct sales or some other services which are provided by this permanent establishment, it has to be similar activities. If these are the similar activities, so in my example, through PE they had earned 35 crore, through direct business they have earned 45 crore. So whole 45 crore plus 35 crore, whole 80 crore will become taxable in India according to United Nations models. For interest income, so what is the law for interest income? Who will take the tax on interest income? A right to tax interest. Okay, so first para confers the right to the resident states to tax interest. Obviously, according to OECD model, you can understand, again, if somebody is earning interest in India or from India, this is the right is given to the resident states. So but obviously this non-resident is investing in India and India is paying interest, so the source is located in India, then India should earn some amount of tax on this interest. No, yes, therefore para 2 says confers the right of source state to tax interest. Now you will say, sir, the same para 1 and para 2 are contradicting, because para 1 is saying it should be taxed in the resident state and para 2 is saying it can be taxable in source state. Please understand, it can be taxable, it has to be taxed in resident state. So either resident states will take the tax or resident state plus source state both will take the tax. Only source state will never take the tax. Okay, so this possibility doesn't arise. Either only resident states or both combining, they will take the tax. The best example is combination. In India, whoever earns the interest, it is usually taxed in the both the country. But then if tax in the both the country, then obviously the person who is earning the interest will suffer a lot. And because the person who is earning should not suffer of double taxation in the source state as well as the resident state, so OECD model as well as United Nations model puts a limitation. It puts a limitation. Even if it is going to be taxed in the source state, it should not be taxed, it should not be taxed at the rate more than 10%. Please understand. So maximum tax rate according to the OECD model should be 10%. Maximum, it can be less than 10%, it can be 5%, it can be 2%, it can be 1%. It cannot be 12% according to the OECD model, and that too it will be taxed on the gross basis. So what do you mean by gross basis? You already know the NR taxation. Whenever we apply the rate of 4% interest or 5% tax on interest, definitely we don't give any deduction. Gross amount means whole amount will become taxable, isn't it? So look at this. Generally, interest is taxed in the source state at a given rate on the gross basis. Very, very important. Gross basis means without deductions. Please understand, without any deductions. No deduction, full amount will be taxable. However, if the beneficial owner of the interest is the resident of the other contracting state. So here we are having resident in the foreign country. Then the tax so charged by the source state should be less than specified percentage of the gross interest. And according to the OECD model, the maximum tax that you can charge on the interest is 10%. But for United Nations model, little liberal approach is given because they are developing country. They say this 10% can be 12% or 20%, whatever it is, the percentage will be defined by mutually agreed. Okay. So, but United Nations model convention leaves percentage to be established through the bilateral negotiation. So both the country will sit and they will decide. I'm telling you, majority countries are having 10%, not more than 10%. Definition of interest. So what do you mean by interest? Define interest for us. In exam, they may say what is covered in interest. Interest means income from debt, claims of every kind, whether or not secured by the mortgage. So a secured loan, unsecured loan, both are covered. And whether or not carrying any right to participate in the debtor's profit. So it can be participating debentures or non-participating debentures. Specific inclusions in the definition of interest as per OECD model and United Nations model. Income from government securities are also covered in here. Income from bonds and debentures also covered. Premium and prices attaching to the such securities and bonds and debentures. Any other premium, any other prices, any other extra income given by the entities is also covered here. But very important, very important, if you do not pay interest on time, obviously you will be a defaulter, and then now you are liable to pay interest and penalty or penal interest. So interest does not include penalty charges and late payment. Okay, that is not included, that is excluded. This is very important for MCQs. For royalties, what is the law? For royalty also same law. I should say same law like interest. Okay, you should understand one thing. According to the OECD model or both the model, the royalty should be taxable in the country of residence. By default, they give the preference to resident state. Sir, but source state in India, the foreigner is putting the royalty, putting the patents in India, putting the IPS in India. They are using the IPS in India, and India is paying royalty income. Obviously, India is paying royalty income. Then it should be taxable in India on the gross basis, and we have already learned the section 115A. In that section, we have learned that yes, they tax it on the gross basis. 10% of the royalty income is taxable in India, isn't it? Now, if it is taxable in India on the gross basis, definitely there will be a maximum rate of tax defined by these two countries. Look at this. Right of tax. Royalty arising in according to OECD model first. Okay, for developed countries. Royalties arising in the source state and the beneficially owned by the resident of the resident state is taxable only in the resident state. So obviously OECD focus more on resident. The resident state has exclusive right to tax the royalty income. This is there in OECD model. But United Nations model is little liberal and it is giving more benefit to the developing nations. As I told you earlier, royalties may also be taxed in the source state. May. That depends upon your DTAA agreement. Okay. However, if the beneficial owner is the resident of the resident state, that is foreign country, the tax is charged by source state should be less than specified percentage, and that will be established by bilateral agreements. Usually it is 10% again. So what do you mean by definition of royalty? Is there any difference? Yes. For United Nations, the definition of royalty is wider because we want more income to be taxed in India, countries like India. And in OECD model, this, rental for films and tapes used for radio and TV broadcasting, rental for industrial and commercial specimen and equipment is not included in the definition of royalty. But for Indian countries like India, definitely the definition of royalty is very wide. Okay, rental for film or tapes used for radio and TV broadcasting, and even equipments, rent is also considered as the royalty, please understand, and because of that we are having a right to tax this royalty income in India according to DTAA. Fees for technical service, FTS, again important article. This article is there only in United Nations. It is not there in OECD model. Again, it is favoring the countries like India. In 2017 update, the United Nations Model Convention has inserted a specific article pertaining to fees for technical services. There is no specific reference of FTS in the OECD model. Right of contracting state to tax this for fees on technical services according to US model. So who is having right? This confers the right to the resident state. By default, right will be given to the resident states to tax FTS. However, it does not state that the fees for technical services is exclusively taxable in resident state. That means they can share the revenue. Obviously, we are talking about sharing the revenue. Resident state should also get some component and source state should also get something. So both countries should share some amount of revenues. Okay. It establishes that, para 2 establishes that the right of the source state to tax fees for technical service is in accordance with the domestic law, subject to limitation on the maximum rate of tax. That is again 10% approximately, to be established through the bilateral negotiation if the beneficial owner is a resident of other contracting state. So you can see the interest and royalty and fees for technical services, the taxability is almost similar. You just need to learn the differentiations. Okay. So what do you mean by meaning of FTS? Again, this meaning we have discussed in section 194J TDS. The same meaning is adopted here. Fees for technical services means payment for managerial, technical and consultancy services, but exclusions. Some exclusions are there. Payment to employee, there is no professional payment. They are just employees, so it is covered in the salary concept. It is not a fees for technical service. Payment for teaching in or by an educational institution. So teachers are not providing technical services. Payment by individuals for personal use. For personal use, obviously we are not going to consider and it is only for business transaction you can have a right. For personal use, if you are making the payment, obviously the taxability will not arise. So these are the main incomes which we have discussed here: business income, interest income, royalty income and fees for technical service. Most important income which are taxable in India so far as non-resident are concerned. So all these articles of this lecture are also important. Please study.